Good morning and welcome to our second webinar on the goods and service tax. India has recently introduced the goods and service tax, which is likely to be implemented from 1st of April 2017. This regime is expected to change the landscape of doing business in India. The GST, a single tax on goods and services across India, will apply to manufacturers and consumers alike and has been marked as a starting point for a single market across India, improving economic efficiency and productivity. Today we'll be looking at the implications of GST to UK businesses, covering exporters and investors already in the market, and to look at the impact across sectors. Our speaker will specifically focus on the pharmaceutical and medical devices sectors, affecting UK companies both in India and exporting to India. My name is Kate Matthews and I will be moderating this session. Before we begin, I would like to familiarise you with the toolbox on the right-hand side of your screens. Just to let you know, everyone will be on mute during the course of the webinar. If you do have a question, please type it into the small bracket on your toolbox in the Please Type Your Question Here section. Send this to me and I will take it up during our Q&A session at the end. I'm pleased to welcome our speaker for today's session, Badri Narayan, partner at Lakshmikumaran Sridharan Attorneys. Founded by V. Lakshmikumaran and V. Sridharan in 1985 in India, LNS is a full-service law firm with over 500 attorneys and professionals and 47 partners. The firm has 11 offices located across the length and breadth of India. In Europe, the firm's offices are in Geneva and London. They offer advisory, consultancy, litigation and transactional services in tax, corporate M&A, intellectual property, customs and international trade, international arbitration and dispute resolution, antitrust, merger control and regulatory to clients in India and overseas. Without further ado, I would like to pass you to Badri.
Good morning, everyone. This is Badri here. I'm a partner at the firm Lakshmikumaran Sridharan, as has been introduced. Over the next 20 minutes, I'm going to briefly explain to you all what the implication of the GST is on the pharmaceutical and healthcare market. Next slide, please. I'm broadly going to cover these sectors which are extremely important in India. As you're all aware, we do have a significant amount of investment from the United Kingdom in the pharmaceutical sector in India. We do have both GSK and AstraZeneca, which have been here in India for many, many years. And in terms of the importance of the pharmaceutical industry of India to India and to the rest of the world, it's very well known. And we have some of the major drug companies, medical devices companies, and major healthcare operations in India. Broadly, the healthcare sector can be broken up into drug manufacturing, medical devices, healthcare services in the form of hospitals and related healthcare services. We have a lot of cases of professional form of doctors, support staff, and related professional advisors, and also insurance in this sector. And last but not the least, India is becoming a hub for medical tourism, and to some extent GST may give further impetus to this area. Next slide, please. I'm going to talk a little bit about the current tax structure because we will not be able to understand the implications of GST without really going into this. I'm going to start by saying that the primary tax in India which is collected is excise, which is a tax on manufacture. As you can see, there's a box just after the manufacturer. It's an excise duty plus state VAT. The primary tax collection in India tends to be from excise and from service tax, which is the tax on services. And the individual states levy taxes on the sale of goods in the form of state VAT. Any goods which is manufactured in India typically will attract both excise duty as also state VAT or state sales tax. Any goods which are thereafter sold in the supply chain all the way up to the consumer typically only attract the state VAT. But the state VAT is an origin-based tax in terms that the state from where the goods are sold typically retains the taxes which are levied by it, and therefore the taxes on the goods can end up in two different states. This is one of the major reasons why there was one cascading effect of taxes in India, and also a dichotomy with respect to certain states benefiting from the current origin-based taxes while the consuming states used to suffer. This also led to a supply chain which was not always efficient, because you typically opened up warehouses even in states where there was no or little consumption to ensure that you got tax breaks from an indirect tax point of view. In a typical structure, when you import goods into India, you pay basic custom duty. You also pay something called CVD, which is an additional duty of customs, which is to offset excise duty levied in India. And you also levy something called SAD, which is to offset state VAT. These can be quite complex and require extensive analysis and understanding of both the HSN as also the excise duty structure and the individual VAT structures in the country, and therefore they tend to be complex and can be difficult to comply with. Once the goods have been imported, they can either be sold directly through a trading channel, in which case only state VATs are applied, or they may be used as an input for the purpose of manufacturing and then resold through a supply chain method. When it comes to drugs, India has always had a low duty rate structure with respect to life-saving drugs. They also had low duty structure with respect to parts used with respect to medical equipment and with respect to certain pharmaceutical products. However, India typically had an inverted duty structure when it came to pharma sector, when it came to drugs, because the API, which is the active pharmaceutical ingredient, used to attract excise duty at 1.5%, while the bulk drug, which is made using it, would attract either 6% or 5% or a lower rate of duty. This typically resulted in a huge accumulation of credit, that is, huge accumulation of input taxes, which typically used to affect the way you would price your goods in the Indian market. Going forward, there is a hope that in GST, these issues with respect to inverted duty structure will be addressed, and the duty structure which is favorable in terms of certain life-saving drugs, pharmaceutical drugs, medical equipment will continue to be applied. So this is in brief what the tax structure in India looks like. Going to the next slide. Before I go into what is the GST and how GST is going to be implemented, I would like to state that GST is going to be implemented slightly differently in India as compared to other countries. We are going to give input tax credit on taxes paid on transactions across borders, and therefore the GST in India is loosely called the Integrated Goods and Services Tax or Interstate Goods and Services Tax or IGST tax, because it allows for taxes paid in the origin state to be transferred to the destination state through a mechanism called IGST, which we will see in a minute going forward. But typically, this requires a cooperation among all the states to ensure GST is successful. And therefore, the GST model which has been accepted or been agreed to between the states and the center is called a dual GST model, and it places the power of GST in the hands of what is considered to be the GST Council, which is the Council of Finance Ministers of the individual states, along with the Union Finance Minister, the Union Minister of State for Finance. A combination of all of these finance ministers are to decide various policies, including things like what should the rate of tax, what should the exemption should be provided, what should the threshold after which the person needs to take a registration and pay taxes, what is the place of supply, that is, where is the consumption of goods and services to take place. Also, what are the model laws and what are the principles of levy, and how the interstate GST is going to be apportioned between the states is going to be decided by this GST Council. This GST Council consists of 31 states. It also consists of the center as a part of it. It has put together a working mechanism by which any decision of the GST Council will be passed if there is 3/4 majority, and the center has got 1/3 voting power to ensure that the states do not hijack the GST Council. And therefore there is a balance of power which has been agreed to with the states and the center to implement GST in the system. We are also implementing this through something called the GSTN network, which is a network which is going to run underneath the entire GST system, which is going to allow people to be able to upload information relating to their tax assessment in the form of invoices and returns, and will simultaneously check by something called a matching principle to ensure there is tax compliance between the vendor and the customer, whether there is a B2B transaction, to ensure credit is available. This is a new system which is being introduced into India, and something which has been under works for more than a year and a half, and is being prepared by a top IT company in India called Infosys, along with the GSTN. At this stage, we're at the stage where the GST Council was constituted on 16th of September 2016, and they have taken major decisions already with respect to the rate of tax and so on and so forth. And we are expecting somewhere in the month of November that the GST laws will be introduced in the Houses of Parliament and the individual state legislatures to allow it to be passed so that it can be rolled out on 1st April 2017. To ensure that GST is operational in India, two central GST laws in the form of CGST and IGST will need to be passed by the Union Parliament, and 31 SGST laws, that is state GST laws, will have to be passed by the 31 states, okay, and likely to happen in the next month and a half. Once this is done, we will be in a position to roll out GST on 1st of April 2017. We expect the rollout to be somewhere between 1st April and 1st July 2017. There is a deadline that GST cannot go beyond September 2017 because there is a constitutional provision which states that once the GST Constitution Bill became Act and was given effect to, after 1 year of the passing of such amendment, any law which is inconsistent with GST will automatically expire. Therefore, state VAT, entry taxes, excise, and various other laws which are today in place in India will automatically not be operative by a constitutional mandate once September 2017 comes, because in September 2016 we have given effect to GST. Next slide, please. Just to give a brief background, GST in India is similar on principles with respect to what is GST understood in other countries. What makes it powerful is that even though it's a destination-based consumption tax, it's a multi-stage tax, it's a value-added tax, the crucial thing is it's going to ensure that there is going to be a seamless credit chain across the entire supply chain, because various taxes are all going to be subsumed into, realistically speaking, one single GST. If you see on the right hand side, I have put some of the taxes which are currently in play, and many of them do not have credit on an interchangeable basis from one to the other. For example, we have a central excise duty, we have excise duty on Medicinal and Toiletry Preparations Act, additional custom duty, special additional duty of customs, state VAT, which does not give credit to any of the taxes above. Then you have central sales tax, then you have service tax, then you have various entry taxes and cesses and so on and so forth. So we have a fairly complex indirect tax system in India, and all of these taxes are going to be subsumed to form a GST, and on every transaction there will be a levy of GST by the center called the CGST within the state, and a levy of the state legislature applying a state GST on the same transaction within the state. Where the sale happens across the state, we have something called IGST which will be applied, which you will see in a minute. The most crucial thing is GST is going to remove what we have today as a cascading effect of taxes. By making this a destination-based tax, it ensures that businesses can now design their supply chain in the most efficient way based on consumption rather than tax consideration. Truly speaking, if implemented properly in a systematic manner with proper planning, the entire system can be fiscally neutral. That is, tax will have no impact on how businessman does his business. The important thing, however, also is that GST also does not allow you to provide any incentives in the form of tax breaks, especially for attracting investments into backward areas. And whatever current incentives have been given for development of backward areas in India in the form of tax breaks will be currently grandfathered, but will over a period of time be allowed to expire or will not be renewed going forward. Therefore, GST is also going to put an end to subsidies being given in the form of tax breaks in the Indian context. So these are certain things of importance to understand why GST is important. The impact of all of this is that we expect that all the taxes which are ingrained today in the goods and services consumed in India and exported out of India are likely to be filtered out of the goods and is likely to reduce the prices of goods on an average across the board by about 2 to 5%. That's really the expectation from this GST, and once the system becomes more ingrained and businesses understand how GST works, there's likely to be a drop in the prices on an overall basis, and that's likely to, one, improve export and also ensure that if it is managed properly from a tax point of view, can have a great amount of incentives for goods such as pharmaceuticals, where you can have a reduction in overall pricing going forward, because truly speaking, you will be able to exclude all the taxes which are ingrained in the goods and services. Next slide, please. This is the dual structure of GST which I spoke about. If you see the left-hand side of the screen, you have something called the state. It's called a local supply. This is a situation where a supplier sells to a consumer and the entire transaction happens within the single state. Say, for example, I am sitting in the state of Maharashtra at a place called Mumbai. So if I am a supplier of pharmaceutical products and I am selling to a consumer in Mumbai, then today, if I am a manufacturer, I pay excise duty and VAT. Going forward, I'll only be paying CGST and SGST. CGST paid to the center and SGST paid to the state of Maharashtra. In addition to excise duty and VAT, I'd also pay a variety of other things such as entry taxes and so on and so forth. All of those will go away. I'll only have to look at CGST and SGST for the purpose of supply of goods in India. Similarly, if I'm going to sell to my customer in Delhi, which is a different state, which is across the state borders, today I pay excise duty and I pay something called the central sales tax, which is 2%, and the consumer can give me something called a Form C, or I pay the entire rate of tax if it's a consumer out of state, or I will do a stock transfer and I'll sell. In any case, it will be excise duty and a VAT or a CST which will be applied on this transaction. Tomorrow, I only pay IGST, which is an integrated GST which I pay to the center. Then it's the center's headache to be able to transfer that credit to the individual states and for it to be the same. The interesting thing is the consumer, if he's going to be a reseller, can take credit of IGST and utilize it towards the payment of taxes for CGST and SGST for sales made in that state, or further IGST sales if he's going to make sales outside the state. Similarly, if a supplier has received the goods in the form of, the supplier has got CGST, SGST, having bought the goods within the same state and makes a supply outside, he can utilize CGST and SGST of the state for the purpose of making the payment of IGST. So it gives you a lot more interoperability. The key is supplier need not take registration or need not go to the next state to be able to comply with the law. He looks at the origin from where he is going to make the supplies. He is going to pay the taxes in that state. Depending on whether the sale is a local consumption, he will pay CGST, SGST. If it is consumption across state borders, he will apply IGST, and that's how it is going to go forward. Next slide, please. So the key in GST, which is going to have a lot of implication, is registration. We have come up with a model which is very unique in the world, in that it is providing credit for taxes paid across the border by allowing a system of being able to pay your taxes on interstate basis in the origin state, and the GST and the IT network allowing the taxes to be transferred to the consumption state. Because we are going to introduce a dual GST model, individual states retain the right to tax transactions within the state, and therefore require you to take registration in every state where you have a place of supply. That is, a place from where you are going to receive goods and services and supply goods and services. Which means that every instance of your company or the entity from where the supply is going to be made, even though on an overall basis across India will be a single legal entity, will really be broken up into multiple entities in every state where you are doing business, where you have men and material to provide or receive services. Therefore, your branch offices, your warehouses, and so on and so forth are all likely to be required to be registered. If you see the next slide, go to the next slide, please. You'll find there is no concept of a centralized registration, there is no concept of a group registration, there is no concept of being able to bundle registrations across states that are next to each other. Each state where you are doing business, you'll have to take registration if you have a place of establishment from where you can provide services and goods or receive goods and services. Of course, if you do not have any establishment, you only have a customer, there is no requirement for you to take registration. But in the current model, every pharma company typically tends to have a warehouse or a place of establishment in every state for a variety of reasons. Okay. If in a state you are going to have a factory, a warehouse, a trading entity in the form of branch, or a marketing and sales office, or you're providing output services in that place, in that state, you will need to take registration in that state and comply with a variety of requirements which you must fulfill. In every state, you must also designate a principal place of business where your books and records are to be kept, and from where you will need to reconcile. And if there is any tax audit, you must satisfy the tax department. Okay. You're also going to have multiple registrations if you want for multiple business verticals. And of course, there will be no separate registrations for SGST and CGST. Those are going to be under a single registration. Okay. And depending on the registrations, you are also required to file 3 returns per month per registrations. So if you have India-wide registration, the compliance does increase, which requires you to have robust IT systems to be able to comply with this. Next slide, please. From a pharma sector point of view, some of the pros which we can see immediately is that you're going to have a lot more credit being applied towards the supply chain. There are also some indications the inverted duty structure may be addressed in the GST, which will also be good because it will allow for greater amount of utilization of credit and less accumulation of credit. It will also allow for supply chain optimizations to be done. If the inverted duty structure were to continue, the government has promised that they will refund whatever input taxes which we are not able to utilize going forward, which is a very big boon because currently one of the biggest problems the sector faces the inverted duty structure where APIs tend to be taxed at a higher rate and the bulk drug tends to be taxed at a lower rate. Of course, we are also expecting a higher rate of tax in general in GST. We also don't have likely to have area-based exemptions, that is backward areas exemptions. You'll need to have more compliances and checks and balances in place. And if you are going to do a warehouse model where you're going to warehouse the goods and then resell them in the market, slow-moving inventory is going to have a higher working capital requirement, because once you move the goods from one registration to another registration, you will need to pay a tax on such removal, which is going to have an impact on working capital. Next slide, please. There is a lot of emphasis on Make in India right now, and we expect this emphasis to continue. There's going to be a differential rate of tax when it comes to basic custom duty in India when it comes to import of goods versus import of parts. That's been kept to ensure that people who bring in parts manufactured in India will be given a higher tax break. Today, when you import goods into India, you pay basic custom duty, CVT and SAD, and a variety of other cesses, taxes and so on. Tomorrow, you'll have to pay BCD plus IGST. So the IGST may be a higher rate as compared to CVD plus SAD, but is likely to be more uniform, allowed as full credit, which can be utilized across the entire thing. You're also going to you don't have to take into account various other compliances to ensure credit is transferred in supply chain. In the current regime, it becomes much simpler when it comes to credit availability, provided your compliances are good. But we still expect that basic custom duty differential is likely to be there for goods versus finished goods, parts versus finished goods, and that's something that is going to be part of the Make in India campaign that India has been pushing forward for. Next slide, please. Last but not the least, some key concerns for pharma sector, which I thought I will highlight. So they're in the current sector, and there is still clarity is not completely coming through in the law which has been stated. We have something called MRP-based valuation, which is a maximum retail price-based valuation, where based on what the final price of the goods is going to be, there is a notional value on which you are required to pay excise duty or other taxes. That's likely to go away. It's going to be transaction-based, but there are certain risks associated by moving away from MRP because it increases risks with respect to valuation disputes and so on and so forth going forward. So that's one area where there are certain concerns. Valuation of free supplies and tax treatment of physician samples are again up in the air right now, because under the GST regime, all supplies are required to be taxed, and specifically supplies without consideration for business purposes are deemed to be supply for the purpose of GST, on which you must determine what the value of the goods is and pay taxes on that. That is fairly new to the Indian GST system. It's something we should have to look at. In the pharmaceutical sector, there is a lot of loan licensing, outsourced manufacturing, and so on and so forth, agreements. How you are going to value, how you are going to treat the transactions between loan licensees is still something which is being debated, and there's likely to be more clarity. But again, it's likely to pose a few issues with respect to this area. We also have issues with respect to how life-saving drugs and healthcare services are going to be treated, whether current exemptions are going on, are there going to be new exemptions, or are there going to be change in policy. That's something again which is still undecided. And last but not the least, one of the key things is how is discounts and target incentives and other trade promotion schemes going to be implemented under GST. There's a lot of issues because only discounts which are linked to invoices are likely to be given effective in GST. That's what the proposal is, to minimize what they feel are transactions which are not trackable. So trade promotion scheme is one area where there's likely to be a lot of changes which the company have to implement to be able to succeed in GST. This is in brief what the GST means for the pharmaceutical sector. My own sense is it's going to do more good, and we're going to, in the medium term to long term, see various benefits and incentives for doing business in India. There's going to be more uniformity. There's going to be much more ease of doing business, and a less complex system to go with. Of course, you will have to account for higher amount of working capital and higher amount of compliances. But I guess if you're able to do that, the benefits of supplying to the Indian market are fairly good. That's what I have to say. I'm happy to take questions. Over to you, Kate.
Hi Badri, thank you for that very detailed presentation. We currently don't have any questions. However, if anyone does have any questions, please do email events@ukrbc.com and we will certainly pass those on to the speaker. Thank you so much for your time. I hope the webinar was valuable to you. If you do have any feedback or comments about today's session, or indeed a session that you'd like to see us do in the future, please feel free to get in touch. Thank you so much for joining us.